Well, thanks, Kevin, for having us. I tell you, I look forward to this every year. It's a great opportunity to get a lot of new ideas starting a year and seeing a lot of old friends and meeting some new ones. And good opportunity to turn off all the ESG and DEI bullshit we deal with every day in the real world. Being with like-minded thinking people is always a pleasure. I guess I'd like to start out by just talking about a few anomalies I see going on that I think are affecting quite a few things in our business at the moment. The first is weather, and I'd like to look at El Nino. I think it's amazing to me how we've seen in the past year 5 different water systems that are literally at low water levels. You have the Amazon Basin, the Panama Canal, the Danube, the Rhine rivers over in Europe, and of course our Mississippi River. And I can't recall ever seeing a time when we had all these five systems that are so important to the transportation of our crops and commodities be at this kind of a low level together. What does that say? I don't know. Is it God-made? Is it man-made? I don't have a clue. But what I will say is I think it's becoming clear that climate and weather is going to have a much more important role going forward in determining price and price direction. I mean, the logistical costs of all this is really taking its toll on the overall profitability of the industry. I'd like to take a look at China. I mean, it's amazing to me. I'm shocked at how much corn and beans China's bought from South America this year so far. You know, they're buying from everyone but us, even though we should have some leverage, given the fact we're their largest consumer product destination. I don't think we're using it in the right way. We don't have, obviously, the right trade negotiator on stage at the moment, do we, Mr. Doud? But seriously, I'm amazed at how much they bought. I'm more skeptical of how much they're projected to buy. I mean, there are projections out there that China is going to import 115 million tons of soybeans this year. Given the outlook for their economic picture, I just have a hard time with that. I have a hard time getting to 105 million tons myself. I mean, yes, herd levels are maybe 10-15% above where they were in 2008 when before COVID, but I don't think anything justifies this kind of a macro outlook on their imports. So if it does, then why are they doing it? Why are they building reserves? Is their intent to invade Taiwan, as some people think? I certainly hope not, and I don't particularly think so. I don't have a clue for that matter, but it's something that needs to be monitored, and I really look forward to hearing a few other people on the panel who might be able to shed some light on that for us. Well, I'm sure Walter and Emily and many others are going to be talking about renewable fuels and the impacts of that on soybeans and products. So I'll turn the page and skip over that and spend a little time talking about corn. Generally speaking, from a 30,000-foot elevation, assuming weather is neutral, and that's a big assumption after I just got done saying climate's going to be everything, I think that I'm bearish. I think the USDA was wrong in raising the exports last month, 150 million bushels out of the U.S., and I think that the crop that's in the field that just got cut is bigger than is currently being projected. Now, right now, the USDA is projecting a 2.13 billion bushel carryout this coming year. On Friday, we're going to get a week from Friday, the final production number, so we'll have a better sense of that. But at the end of the day, I think we're going to be closer to 2.4 billion than we are 2.1 billion. And as always, there's a lot of debate over acres for the coming year. I think that, you know, soybeans are the darling now with the value premiums that are being paid and the additional profitability over corn right now. I think it favors soybeans, certainly. So a few people I've talked to here and just in general lately think we're probably at 90 million corn bean kind of combo. I don't have a big problem with that. I wouldn't be surprised if we have the right kind of spring weather, that we're closer to 91 million in corn than 90. I think that farmers like to plant corn as quick as they can. And I think that getting that kind of rotation switch may be a little difficult. So let's just call it 91 million for sake of conversation. And when I take my really, really fuzzy crystal ball out and look for the future, I think we're looking more at a situation where we could add 500 million more bushels next year to our carryout, again, assuming normal weather. which would then take us up over into that 2.9 to 3 billion bushel carryout type level. And if all that happens, and there's a lot of ifs there, I keep reiterating that, I could certainly see corn, old crop corn trading down in the $4 area, maybe a little below, and I think new crop corn could trade down to $4.50. I think there's the cash markets for the last 6 months have been telling us demand sucks. We're cash markets are trading well below delivery. We've taken markets from pretty inflated inverses all the way to carries, and I think those carries are going to stay here. And I think as we get closer to each delivery period, we're going to see carries continue to widen out. I was kidding with someone yesterday saying that is corn going to have any VSRs in 2023? Emily? No, I'm kidding. No, 2024. But seriously, I do think that the demand and cash markets are really telling us that demand isn't there. And I guess the last thing I see in terms of problems for corn is the fact that historically farmers sell about 60% of the crop by the turn of the calendar. This year, I don't know, I've talked to a lot of people, I think it's closer to 30, maybe 35%. And, as they used to say in the Florida Board of Trade, he said, a long farmer is the most bearish thing there is. So I do think that we're going to see, a lot of willing sellers on rallies as we go forward. I guess the only couple friendly things I see right now in corn is over the next 10 days or so, we're going to see index funds as they, as they repurpose their portfolios, buy anywhere from 75 to 80,000 contracts of corn, and they do that pretty much systematically. So that's a kind of a given. And then, of course, we have no idea what the second Brazilian corn crop is going to look like, their safrinha crop. And there's a lot of debate over how that weather plays out, because in a lot of ways we are becoming the residual supplier, assuming that they have a normal or good crop. I guess I'd like to switch over and talk about wheat for a minute, where I have a little more optimism, ended on a good note. Basically, the global stocks-to-use ratio are near record lows for all the major wheat exporters. And that's happening on the heels of two back-to-back record export years out of Russia. In the middle of a war, they've had two of the best export years that have kept a lid on things. And Kazakhstan is starting to show up as a new supplier in the world market. At current levels, it's hard to imagine we're going to see some sort of a acreage reduction in the U.S., and we're going to see some acreage reduction in the EU. It's something to keep an eye on, particularly with these low stocks-to-use ratios. Another dynamic that we all need to watch closely is India. Over the past several years, they've become a very predominant and relied upon supplier for many poor countries for their cheap sources of wheat and rice. And this year, India has banned exports of both. I think that's probably due to a few things. One, last 2 years they've had somewhat of a subnormal monsoon seasons, and that's cut back their supply chain to what they consider to be pipeline minimums. And two, it's an election year down there, and the election's in April. The one thing you don't want to have as an incumbent or anyone running is to have food inflation. So keeping a lid on prices has been job number one, and I think they'll keep this ban on certainly through the elections. And I think the real question is, are they getting to a tipping point where their consumption is improving to the point where they won't be a reliable supplier in the export world going forward? I think that's just something we need to keep an eye on. So the point being that the stocks-to-use ratios are as low as they are. There's a lot riding on Russia, on the Black Sea, and on Indian production this coming year. So weather this spring in the Northern Hemisphere is going to be critically important. And with the funds big shorts, prices as cheap as they are, I certainly think there's a hell of a lot more upside potential than there is down. And I guess, we'll come back and have other conversations, Kevin, but I just wanted to get that out there.
Yeah, I appreciate it. What, you think D's 24 corn trade below $4? We're trading close to 5, but I don't know, we're 4.97 today.
Below 4.50, I don't know if you're going to get all the way down to $4, because if you do that, then you're going to have to be closer to $3 or $3.25, $3.50 for D's corn or old crop corn. I don't know if you can do that. I'm bearish, but not quite that bearish.
Yeah, I mean, front month's close to 450 now, so we're 460 somewhat
Yeah,
in
so we'll
March.
go down to $4. I mean, you can break 50 cents in both, maybe a little bit more.
Yeah, that's what I think. Front end could maybe test it, yeah.
Yeah.
We'll see where D ends up.
Hey,
Dowd?
Kevin?
Yeah, hang on, Walter, hang on.
No, I don't want to, I don't want to take it off. I would just like Andy to reflect a little bit more on a very important point. I'm going to touch on it as well. And that is, Andy, I'd ask you, would you ever have imagined the Ukrainians and the Russians could export the amount of wheat that they were able to do in the midst of a war?
Not even close. Maybe Russia because they control the waterways, but, you know, Ukraine, no, I wouldn't. And it's almost like it's an afterthought. I mean, 2 years ago, we were at, you know, $14 wheat, freaking out as a world, $13 wheat because about what would happen. And now we're at less than half that. And it's not even become a blimp on the radar. So no, I'm as shocked as I could be.
And in my world, and Kevin, I don't mean to, I'd like to keep going on the macro and we can come, because you know I'm going to really focus on oil seeds. But the same thing, the amount of sunseed production that came on to global markets out of the Ukraine in the midst of a war it's just amazing. It's absolutely amazing. And for me, and again, from my world in oilseeds, the miss I've had is just the Ukrainians being able to move to market. They obviously don't want to keep any production in store and put it at risk to disaster from a war, so they've just been dumping things on the global markets, and it's astounding. To me, I can't get over how the global markets have been able to sit back, watch a war happen in two key production areas, and build no risk premium into prices. I've been at this 36 years. It's just absolutely astounding to me, and I think it's a major theme moving forward.
Yeah, let's talk to Gregg for a minute. Doud used to be the former trade advisor for President Trump. Now Gregg has moved over. First day, Gregg, second day on the job.
Second.
President of the National Milk Federation, correct? Mm-hmm. And what's your overall view, Gregg, on what's happening? Just overall view of the landscape, what's happening in the cattle space and dairy, and then, you know, overall general ag space and sector.
All right, can you hear me? Everybody hear me here? 5 or 6 quick points, and I'm going to go quickly as I can. 2023, in terms of ag exports, it was the strength and the value of the dollar that killed us. What's fascinating about this, Kevin, is if you look at the DXY on November 1, it was at 107. On December 27th, it was at 101, and this morning when I checked, it was 102.5. That is an unbelievable amount of volatility in the dollar, and obviously that's related to interest rates in the U.S. and the Fed talking about what we're doing there. The question is, have we already seen the low in the dollar, and are we coming back? This is an important question. The number 2 thing that I'm going to talk about, and I spent a year of my life, 2019, which is hard to believe, 5 years ago now, negotiating with China. I want you to know this. The Chinese economy is a mess. I don't believe any data point coming out of China anymore. Here's a couple data points, though, that really inform me. When I started here a few weeks ago with National Milk, and we were looking at total U.S. Dairy exports, I said, what's going on? What's the problem? And I have a great team of economists, and they said, Gregg, the problem is that New Zealand's dairy exports to China are way off the mark, and their product is backing up into our lap and other markets. Well, folks, January through October 2023, New Zealand dairy exports to China were off 31%. And we have been asking in the meat side of the equation, and I talked to Brett Stewart, who's one of the best international meat analysts in the world. He and I have been talking about this month after month after month. What are we seeing on beef and pork and poultry imports from China? And the answer is they're good. Some of the months have been record still, rocking and rolling until October, where we saw this dip. And then I got an email from Brett yesterday afternoon. Folks, total beef, pork, and poultry imports by China in November were off 17%. this is not a good sign. And the reason I say this is because total ag imports from the world to China in 2022 were $236 billion. To put this in context, total ag exports to the world in 2022 were $196 billion. There is nobody else in the world, Andy, that can absorb this kind of production if China isn't going to do it. And I'm pretty worried about China and what's going on. A couple other quick points. We've got to talk about the Panama Canal and drought in terms of U.S. competitiveness. We have to talk about competing supplies, and you'll talk about this, Brazil and Argentina and their double cropping and whether they can continue to do this. We have to talk about Fed policy and GDP and interest rates and everything that's going on now. Quick question, how many of you have had the conversation with your banker about your operating note in 2024? Raise your hand. It's going to be closer to 9% than it is 8%, and Kevin's already talked about it. It's one of the biggest factors that I think we have coming. Last thing one point I want to make here is the last thing I said here, Kevin, last year at this table was what? We were talking about a massive 100 basis point increase in interest rates, and I said, you guys aren't nearly high enough. The question I have this year is, I'm pretty negative, and I hope I'm dead wrong with my thinking on this, but we've had a big lag between the increase in interest rates and when they've taken effect. My question for this year is, can the Fed reverse and lower interest rates fast enough to prevent a hard landing? And I don't know what the answer to this is. I'm a little concerned about it. I think in 2024, we're going to talk about greenhouse gas emissions and the fact that if you sell those emissions, they are no longer yours. And you're going to have conversations in the food supply about who gets those emissions and who gets to keep them. If you sell them to BP, they're no longer a part of this conversation. We're going to talk about labor, regulation. The biggest problem in our government today was already discussed is we have all this great technology in agriculture and in Washington. You can't get the FDA or the EPA to do anything to approve anything. And so these investors, Kevin, can't get a return on investment. So what's going to happen? Our government is choking us off on technology and agriculture. At the same time, what has happened in China in the last couple of months? For the first time in history, China has told their farmers, you can plant biotech seeds. So they're going one direction while we're kind of sitting and stagnating on the other. Last word I'm going to use for my final comment, Kevin, this year, the word of 2024 is going to be consolidation.
No, I kind of agree with Gregg. So we get a lot of data. I get data every week that shows air quality in China, particularly is what I'm watching and monitoring. And the air quality in China in the major factory producing areas and provinces in China, you're still reading at half the air pollution levels that you were pre-COVID. So we know that China has taken a massive hit from a manufacturing standpoint. The factories aren't running at near the capacity. You have a couple of provinces that are maybe running at 50, they're back to maybe 52%, 53% pollution where they were. Some, though, are still, clear as clear, they're at less than 40%, So it's interesting. I'm with Gregg. I think how we're going to replace Chinese demand could be a little tricky here as we move forward just through this next period as they lose some population and the economy continues to struggle. So, Mr. Farley, David Farley came all the way from Australia, a good friend of mine. Known David a long time, and he's run a big cattle operation over there. Now he sends me these awesome, nice blankets now. He's got him a big cotton mill and things going over there, so things are going good. David, tell us a little bit about what's happening in Australia and what you're worried about or what you see happening.
Thanks very much. The first thing I can tell you, it's a long way from Australia here, especially when you do it in one day. And if you are contemplating do it, have a good look at Hawaii in the middle, because I think the 16 hours in the air. After 10 hours, you look at your watch and think, man, I've still got 6 to go. It's a long way. So Australia, it's an interesting position we're in. it's definitely happening in Australia, and it's quite exciting what's happening in Australia, and especially if I put it in context to the agricultural base, which our discussion's about today. You know, we've got a good democracy, we've got a good system of law, we've got accounting and audit, and we've got an environment that attracts investment. So we've actually got a generation of new farmers coming on now that are quickly and rapidly taking in the technology. But Australia at the moment, I suppose, is a kind of a little bit like a college party or a sorority party that you might talk about. It's been a hell of a lot of fun for the last half decade. We've done it on other people's money. In other words, we've partied and boozed on literally imported capital into the country, very low cost, cheap capital, and now we're going through getting ready for the hangover that's going to come with it. Our debt markets in Australia aren't as deep as the US debt markets or the European debt markets. Most people are funding their long-term debt profile to be 5 years, and of course, then everyone's got their operating working capital lines for the year. So we're literally gone from 2 to 3% cost of capital on the working note line now. Anywhere on the cheap side's 8.5%, but it's more like 11 for most people, and that's going to take some absorbing. We've seen asset bases, our land values, treble, if not quadruple, in a 5-year period. We've seen that money not principally come from the agricultural community itself, it's come from outside of it. We've seen a lot of long-term investment money come in, whether it's from Germany, from Canada, or from the United States, and taken really good strategic positions in land, but have also taken big strategic positions in our gateway assets. And the gateway assets are whether they're our cotton ginneries, our grain elevator points, or our abattoirs, etc. The minority, if not nearly none, are owned by Australian corporations themselves. And the challenge that we've got there is, one, maintaining efficiency in them, keeping our cost of distribution, getting it to ultimately market cheap, because the owner of those assets has the ability to put his inefficiencies back on the producer and do it quite easily. And at the same time, the owner of those assets is also the price maker of the commodity that they're putting through there. And in most areas, it's run as a monopoly, but when you actually break it down into the logistics, it's run as a duopoly. It's run as a duopoly, but in most areas it's run as a monopoly over the pricing structure. So we've got some exciting times that we need to be able to now take what we've learnt from the world markets, and Andy's done a great job telling us where it is. We respond to the world markets principally through our seasons. You know, if it rains, we plant crops. If it doesn't, we don't plant a crop. It's simple as that. Determining the price of it is the prudent producer would probably sell anywhere between 10 and 15% at planting, and as his crop grew, he'd sell into it. But the majority of it still is sold at harvest and carried by that international owner of those assets. And that's where we're challenged. So I think when you look at Australia as a whole, we've really enjoyed the party. We've got a government that's really aligned with technology, where we're going, and prepared to invest in it. But we've bored our way into the future with a big pile of debt. And that big pile of debt is a lot of people haven't prepared themselves with 6 Tylenols and some mineral-based drink to try and manage the hangover. I think we're going to find ourselves with some interesting challenges. And it's starting to show up in land values already. If you read the advertising documents, everything's got a price reduction on it now. Then you start analysing the price sales of what they're getting now over the last 5 years, 10 to 15% back in value. And why is it? It's principally because the cost of servicing the purchase, the asset, or the cost of running that asset. So cost of operating those assets now, we pay roughly $4.60 per gallon of diesel in the country. And we've got to remember that our price is based off Tapas oil out of Singapore, converted to Australian dollars. So it's very sensitive to the value of the Australian dollar. Our cost of debt's expensive, and our cost of fertiliser is expensive as well. So even though we've had the opportunity of good seasons in the majority of the country, and relatively good pricing for the previous 3 years. It's just not penciling out for the farmer at the moment. And the consequences of that, when they've got a belly load of debt on at the same time, and banks have got shareholders and have also got terms and conditions with the regulator they've got to meet, I sense that Australian agriculture in itself is going to go through an adjustment period. That's a nice term for saying, as we call it in Australia, an oh shit period. And I think that adjustment period is going to come with liquidation of assets, not only operating plant and equipment, but ownership changes of land, etc. But what do we really swing off is that we're swinging off today a 68-cent dollar. 4 or 5 weeks ago, it was a 62-cent dollar. If we go back to a 72-cent dollar, which I kind of sense is where we're going to go to with our fiscal policy and monetary policy that we're running in the country, and more importantly, if I read what the US Treasury is saying it's going to do and start winding back your rates here, that interest rate spread will change. And Australia doesn't really work. It can operate around 70 cents, but it doesn't really create enough surplus capacity to keep agriculture going healthy. And it definitely falls apart at 80 cents exchange rate. And if we want to try and tame inflation in any way, the only brutal tool that we've got is the cost of capital, which is interest rates. So then the other conundrum we have, which is interesting, 3.5% of our workforce, which is our mining industry, is accountable for 82% of our exports. Now, and of those exports, which are coal, iron ore, copper, etc., principally go to 85% of those total exports goes to one customer, and that customer is China. And the gentleman to my right was just alluding on what we're seeing in China, and I can concur with him that I see the same picture that's happening there as well. So we've set ourselves up on a high social cost society in Australia. Our health systems are good, our pension plans are good, our immigration is generous. We bring in roughly 2,000 immigrants a day. We don't fight them over the border. We bring them in aeroplanes and process them through and put them in buses. We're, it's quite legal, just there's ways around the system. And so we've really got to start addressing our future and the terms and conditions on which we've got it, which will be. Which is interesting because there's a whole generation, and being a father of 3 daughters in their mid-30s now, none of them have been able to come to grips with when I talk to them about interest rates, and especially when I talk to them about, hey, I remember when it was 12, I remember when it was 16, and I remember when it was 18%. So I look at that generation and question, have we got the right psychology and the right culture to manage ourselves into the future without having a massive, massive hangover? But other than that, Australia's pretty good. It's sunshine down there at the moment, it's summer. I've actually come with a bit of a suntan. It's safe, it's too far away from anywhere, but structurally, we've got some issues that we respond to the world. We don't act on the world, we actually respond to what's happening to it. And as I see a lot happening to the world at the moment, and especially to the US and especially in China, is that if we're not careful, our hangover will be one to remember. Thank you.
Yeah, appreciate it, David. Let's move. We're going to go with Mock and then Tom Willis, and then we're going to let Walter and Emily kind of battle it out on this soybean thing. But Mike, how's your year been, or what do we think moving forward? Is the producer undersold, or where are we at here, buddy?
Yeah, I agree a lot with what Andy said. I'm just tickled to see Emily. It's been a long time, and I didn't recognize her now that she's gone blonde. But Emily travels to, everywhere across the world, Pakistan, Indonesia, and so forth. I get to Champaign, Illinois, and Hinton, Iowa, and places like that. But I will tell you that I think Andy is on the money with a lot of his comments, and we did not discuss this beforehand. We're the opinion the crop's going to be bigger next week. Instead of 174.9, it's going to be something closer to 176 or higher. The government's already got Ohio and Indiana at record production, and they're still too low. And I think even in areas in the center, western part of the belt, could ratchet up a smidge. I'm scared to death of the stocks report. Those are typically underappreciated and often have more impacts or surprises. We've had warm weather. Feeding rates, I think, would be affected there. So the 2131, Andy suggested 24. I might be a little less than that, but I'm in the neighborhood. In terms of acreage, the good news, if you're a wheat producer, particularly in soft red country, I would suggest that acreage is down 20%, and that's from Michigan all the way to Mississippi. And in the hard red country, probably trimmed a bit as well. That's a double-edged sword, obviously. The good news is I think it puts a bit of a floor under prices, particularly with futures prices below the insurance price. I'm not in a big hurry to sell new crop wheat today until I see those acreage estimates that come out next Friday. Those could be interesting. But in the new crop, I've been using 91 as what Andy alluded to, roughly 88 for soybeans. We might see a bump in that number, both numbers, given the wheat. In my neck of the woods, we put our wheat in after beans. So will farmers go beans after beans, or will they go to a corn-bean rotation? We'll see how that all plays out. But it very easily, with a 178, which is a very conservative yield for next year, Andy's 2.8 is not out of the question. And this is driven, and when we talk about markets, whether you're talking about equities, any financial instruments, or the grains, we talk a lot about the pain trade, and I think Andy did identify that. I'm in the same camp. 35% of the old crop is priced, 60, 65, 70 unpriced. That's whether it's in the bin unpriced and delayed price or unpriced basis contracts. And I still think the farmer, to a large degree, has, it's a deer in the headlights kind of look. And I know it stings. I went back and looked. March 24 futures, on the last day of 22 was trading 618. So it's fallen out of bed. It's a missed opportunity, and we gotta rip the Band-Aid off and move on. And Emily and I did chat a little bit about this morning. We're still offering good carries in the market. People like ethanol plants and grain companies don't have a forward book on. I'd be looking really hard if I could get a May, June, July flat price bid somewhere close to $5 and say thank you and move on, because I think it's going to be the risk. The challenge is, September corn in 23 traded down close to 450, the Dees as well, and we're only 10 or 12 cents away from doing that in the March, and we may do it in the May, and as Andy alluded to, we may do it in the July. So the farmer's caught here. And he has to go to Plan B or Plan C. I don't see any other way around it. I didn't hear a lot of arguments from the other panelists in that area. Beans are a little bit different. I think the farmers use the beans to cash flow. They like the price all along. Forward sold more. Probably 65% of the beans are booked, and that's been helpful. It's corn where the real pain is. The other thing, and Walter alluded to this, I've done some work on this myself, in terms of everyone on this stage has been stunned by what Ukraine has been able to ship. But if you go back to the turn of the century, Ukraine really wasn't even a player. They raised about as much corn as they consumed, something 6-7 million metric tons on annual production would not have been of a surprise. Now, just before the war, they raised 41, 42, I believe was the number. It's an astounding number. But I think the USDA is in the neighborhood of 28 million tons for the crop they just harvested. There are a lot of private estimates in the low 30s. What happens when the war stops? We talk a lot about Brazil and Argentina. The Black Sea is going to be a thorn in our side moving forward as well. So one of the things that I took from Tom's comments, and Tom talks faster than I can think, but focus on efficiencies here. And small profits might be something that you want to consider. The boom days, the big money that we've made in the last 2 or 3 years, might be all we see for a while, and we have to adjust the way we operate. And that starts with catching up on the old crop mess and focusing on new. So global competition is a real problem. We've got a lot of unpriced old corn. And I was really bothered by the way the market traded yesterday. That's a signal from managed money that they have no interest, despite the currency has dropped precipitously, as Gregg alluded to. And yet there is no interest from the spec money in terms of getting long a grain. And that sets a poor tone moving forward as well. So count me in the bear camp too, I guess, Kevin.
Yeah, I think we're hearing the same type of thoughts. Like I said earlier in the conference, I think there's a time to back up the pickup truck and really load it up and haul off some big money, and then I think there's a time to try not to lose money. I feel that's where we're going here. We're going to cycle a little bit. That's why I think, Mike, we don't have any price risk left in the current crop, and we were aggressive selling early. But I'm also aggressive selling early in next year's crop. So we're 30 to 40% priced. Andy will tell you, I'll tell you, you guys are just like traders on the floor, or just like traders in Chicago or New York. I mean, it's really hard to trade if you don't have a position on. And it's hard to then psychologically make your next move. So everyone's always focused on price all the time. I think it's more important to focus on time and then your psychology, your personal, how you're going to be when prices go lower. All I'm saying is you got Deese corn trading out close to $5. Go out, price 30% of it, throw a stake in the ground, and hope to hell like it's your worst sale. And then start to maneuver around it. Don't you agree? That's how we build positions in the market. You can't go from nothing to then making a move, because psychologically, your next few steps, you'll just get mind twisted. I mean, it'll drop lower, and then you're stuck, like Mike says. You get the deer in the headlights look, and you're like, well, shit, I could have just sold it at $5. Now here we are at $4.80. I'm going to wait a minute. And the next thing, you're at $4.50. And then you just go to sleep, put your head in the sand, don't even look at it again, and hope to hell something changes, right, Andy? I mean, and that's why I'm just telling you, from a psychological perspective, from trading and pricing, you just need to get an anchor in the ground, and then that's something you can psychologically, you feel a whole lot better. I used to tell everyone, I'd make a sale, and either way, most early sales, I could always tell Michelle, I'd be like, shit, I'm glad I made that sale there, babe. Prices are lower. Or I'd say, damn, I'm glad I only sold a little bit there. Prices are higher. So I felt good about it from a psychological standpoint, and I didn't just start ignoring the market and just trying to forget about it. So that's where we get ourselves in the jam, I think. And then, Tom, let's talk corn, ethanol. Where are we headed with this ethanol space, sustainable and aviation fuel, and where we need to be? Hey, you better pull that mic down to you. Yeah. Put it up there closer.
First of all, there's been a lot of talk about artificial intelligence.
I don't think they can hear you.
Can you hear me?
Yeah, you better hear. Yeah.
I've never been accused of not being able to be heard. Can you hear me?
Yes.
Okay. A lot of talk about artificial intelligence, and I've got one of these iPhones. I just got some new hearing aids. Somebody out there is playing Stairway to Heaven, and my earphones are picking it up.
Really?
So it's an amazing experience for me. Maybe somebody's trying to tell me something. I don't know. As far as the ethanol renewable space goes, 2023 was probably one of the most eventful years. Whether you like our current administration or don't like our current administration, the Inflation Reduction Act had more money targeted towards renewables, which impacts all of us in this room one way or the other. Programs that, in order to be executed on, will have to work their way back to the farm. For and I don't want to get too much inside baseball, but there's a credit out there for producing a near zero emission bioethanol. To get there, especially with some of the trouble they've had with the pipelines in Iowa, they're going to have to go to the farm gate. And I think for the first real time, in my opinion, the marketplace is going to reward sustainable farming practices. And so those of you that have not looked into that need to look into it, because I do think it presents a great opportunity from that perspective. As far as demand goes, Kevin, we still continue to overproduce. We do. With the election coming up this year, this current administration is going to be looking for any place they can get votes. I feel fairly confident that E15 will get another waiver, so we'll be able to kick the can down the road another year with summer blending. That will be good for all of us. One of the programs that is out there is the 40B, which is basically, you've heard about sustainable aviation fuel. That's a huge push out there with the some of the rulemaking that was released a couple of weeks ago is going to make that more possible. Now, it's still heavily subsidized, but if we can get this implemented, it is a huge source of demand for renewable fuel all the way through, and we're going to need it. We will need that. Probably the other thing, Kevin, I would mention is Brazil. There's been a lot of talk about China, and I will tell you that that is a real concern. But a second concern, somebody just changed the songs. Hang on here. I like your music, whoever it is. You got damn good taste. But Brazil presents an issue for us. Their ethanol production is up about 17%, and that is coming directly out of U.S. markets. Now, for those of you that don't live near an ethanol plant, you say, why should you care? Because you can convert that ethanol back to corn. So every gallon of ethanol that we get cut out of export markets on is I should say 3 gallons of ethanol for 1 bushel of corn. It hurts. It hurts us, and it hurts all of us in this room. They're coming into, now I'm going to get a little political here.
Yeah.
I never do that before.
Yeah, do it. Go nuts.
But there's a tariff Brazil has on U.S. ethanol going into Brazil. We used to go into that country, and it's 16, 17%. Would it surprise you if I told you that they can bring their product into the United States? They are eligible for every low-carbon incentive that the U.S. government has, and we don't put any tariff on them. If that doesn't bother you, it should. If it doesn't bother you, it should. In election year, you need to go back to your representatives and let them know that this just is not acceptable. It's not acceptable to allow them to come into our country, but we can't get into theirs. And I know there's a lot of politics around it. I'm just telling you that it impacts, and it will impact agriculture if we don't get something there.
I think Greg's got something to say. Greg?
You are correct. That was a law passed by Congress. And,
Well, I said I wouldn't get political.
and I had, when I was in that job, I had some pretty frank conversations with members of Congress about what they did that now requires a change in law to fix that.
We never said Congress was intelligent.
But it's really one state that exploits that.
Yeah,
It's one
California.
state. It's the same state that's come back to you and told you how to raise hogs. I just,
Yeah.
I don't want to get political either, but it's amazing that Donald Trump, when he was running, he had an energy policy, and one aspect of his energy policy, whether you agree with Trump or not, was we're not going to let the state of California have its own policies. This is absurd. And it has a tremendous impact on corn ethanol.
Or
And-
Prop 12 or whatever else we're talking about.
Right, and the Californians exploit it to your loss, and there should be some reciprocal something. I think every train of corn that passes through the states of Iowa and Nebraska headed to California should have a tariff on it to recover what's been lost. But
Emily just made the point, the renewable green diesel mandate is California, so you get the benefit on that side of it as well. But
The knife
yeah,
cuts.
but I mean, to Kevin's point, all of this stuff goes from Europe to California in agriculture and from a regulatory standpoint, and from California to the rest of us. So California is always the, canary in the coal mine on all this stuff.
No, I would agree. Tom, what's the odds on these pipelines getting passed?
What is the chances?
Yeah, of the pipelines.
I don't think very good, because it's becoming an emotional issue.
Yeah.
Personally, I don't understand why. We farm in western Kansas, and those that farm in western Kansas, we got pipelines going all over our ground everywhere, because at one time we were, the biggest natural gas field in the world under the Hugon Field. But for some reason, eminent domain came up in Iowa and in, I think, North Dakota, and it's a local issue. So it's not going to be solved. It's going to be solved on the local side. It might happen, but I don't see it happening anytime soon. And it should, because it would actually, it benefits farmers. It really does. So, and that leads me to another point. At least with this current administration, everything is about low carbon. Whether it be low carbon farming, low carbon production, and I mentioned that earlier, that there's a ton of opportunity there. Speaking of California, a lot of renewable diesel is hitting out there. I think Emily brought that up. And we've seen the price of carbon drop from $200 a ton a year and a half ago, maybe, somebody help me here, a year ago to, what is it, $70 right now? And it'll continue, in my own opinion, to go down as more and more of these renewable diesel plants come up. The thing that's unique about renewable diesel is the owners of most of these are the major oil companies. So they've got big pockets, they've made big investments. It'll be interesting to see how that plays out. California's going to have to do something if they want to hit this 2050 mark, or they're going to have to do something to get the price of carbon back up, and it'll be interesting to see what they do. I have no idea what they're going to do, but it's not sustainable long term for their programs to have carbon worth $75, $80. It's got to be up to around $150.
Yeah. Perfect. Let's hear from, take about 10 minutes. We'll hear from Walter and Emily on the protein side of things, and as far as soy is concerned, and then we'll open it up for some questions. If you have questions, fire them into the app. And like I said, Jordan may have a mic, or Todd or Kennedy, and they'll ask some questions here coming up. So, Walter, you want to tell us what your thoughts are on this soy space?
Absolutely, Kevin. Thank you again for the invitation. Love coming to this event, and really appreciate the opportunity to speak. How many attendees from last year are here? Okay, that's Kevin. Wow, congratulations, man. That's great. That's great. Sticky customer base. If you remember my talk last year, I recommended that if you don't follow soybean oil, it might be unusual for you to have it on your DTN screen that you add it. If those who were here last year remember that, because I said that really is the go-to agricultural commodity to watch. And in fact, it played out that way. That was good news last year, and I come to you this year as a guy. I'm really torn, and those are the worst kind of people to have present, because I'm going to give you two compelling stories. One extremely bearish, and the other one extremely bullish. And so I'm useless, right? I'll stay on the bearish theme since we've started it, and build a little bit on what I said about the Ukrainian war and the ability of Russia and Ukraine both to execute in global markets. The other war that's going on in the Middle East it's absolutely astounding to me. What's going on between Israel and Gaza, what's gone on in the last 2 weeks with U.S. naval activity in the Red Sea, and crude oil's at $70 a barrel.
Yeah.
I mean, I'm from a different world. It is all-out war in the Middle East, with probably in my lifetime the most aggressive Israeli policy towards sort of almost finalizing policy, and yet we're at $70 barrel crude. If the market can't rally on what's going on in the Middle East today, it's not going to rally. Here I'm talking about petroleum, and I'm no expert in petroleum, but I can tell you, I look at the petroleum market, and I'm astounded with what's going on in the world. And something's wrong, in my opinion. Something's wrong in these markets, and I think that Gregg did a nice job of providing some of the statistics on what's going on in China, and I think it's primarily China. But there's just a extremely wet blanket that is sitting on global markets and commodities right now. Extremely wet blanket. You can't spark a fire at all. And again, I think that the crude oil market and what's going on there is by far the best example. And if crude's not going to rally, biofuels are not going to get a benefit. There's no tailwind that's going to develop for biofuels at at $70 a barrel crude. And as we were saying here, it will have implications back to the corn and soybean producer. So something's wrong, and I don't have the answer. But crude to me should be twice its price. It should be $140 a barrel. There's no risk premium that's been built into the crude market. The crude market is indifferent to a major incursion going on and a potential just, we go from whatever could be next on the front page of the New York Times or whatever the next event is, and if it's still not sparking the market, I mean, what's it going to take? Okay, so that's I would say I have a 30% probability that we're in some sort of deep deflationary spiral right now. And that's just as an observer of commodity markets. I certainly don't know anything about interest rate policy or government debt and that. So that's that. Now here's where I'm going to confuse you, because I'm going to come at you with the bullish side. And that's, I follow, and you should all follow, if you have the time, because it's dense reading. Rosenzweig and Goring are money managers that put out their research. They release all their research. So Adam Rosenzweig, I forget Goring's first name, but just you'll find it. As he says in a podcast, he says, if you just do any version of Rosenzweig and Goring, you'll find us. But he has a great essay on peak energy and makes such a compelling case for the fact that global peak energy has occurred. And he goes well by well, major producing area in the world by major producing area, and just makes a very, very compelling case that peak energy is in. And that's really that's the hyperinflationary, super bullish story that could unfold over time. But the reality is, he's thinking in terms of like a 5 to 7 to 10 year period. The reality is we're in a period right now where it's not happening. So biofuels and biofuels policy and what's going to happen, and I'm going to touch on the renewable diesel side here in a minute. That's going to be impacted by the crude market. Gregg's word was consolidation. My word for the conference is storage. It's storage. If you have it, you're going to be using it. And it's going to be we haven't been in the last 3 years, we have not been in a storage market at all. In fact, just the opposite. We've had the curves in the soy complex sharply inverted, so the spot price much higher than deferred prices, with the market compelling all of you to sell as much as you can on the spot and penalizing you if you carried it. And that went supernova in the soybean oil complex with the Ukrainian war and with real concerns about global supplies of veg oils, with the combination of the growth in the U.S. renewable diesel industry and the incursions in Ukraine. And it's gone full-scale collapse. And the last 3 weeks have been absolutely brutal in U.S. soybean oil trade. Absolutely brutal. And we've gone from a sharp inverse promoting conservation of usage, spot sales from everybody who could sell something, to just the opposite, where now we're promoting storage and incentivizing. So not to get too technical, but during the January delivery period, you could earn 4.5% over and above the cost of storage if you took delivery of soybean oil and sat on it through March. We haven't seen that in 3 years. So storage is a function of not enough demand for the available supply, and that's what's going on. And I'm afraid that's with us. That's with us for some time. And there's two elements of that. There is a renewable diesel policy that is also promoting the imports of lower carbon feedstocks. And the one that's getting the biggest benefit from that is used cooking oil. And in the United States, we are importing everybody's I mean, everybody's deep fryer in the world is sort of getting drained and put on a UPS package to the United States. And that's also got some interesting elements of it. But I would suspect this coming year, look for headlines about FBI and other investigations into used cooking oil imports from China into the United States associated with a lot of fraud. Because they're mostly palm oil imports with the sprinkling of used cooking oil in them. And that's going to change things pretty dramatically. But Canada and canola production has also benefited. So when I was here talking to you last year, I was talking to you about the demand was going to swamp the available supply. The ramp up in renewable diesel was going to be so significant that supply just couldn't keep up with it. And we did go through a period of that last year. What's going on today, and there might be somebody here from the petroleum patch or the refining industry that could explain it to us, is just a lot of delays in refining capacity coming online. And that's been a bit disappointing to those of us in the soy processing world. It's had a significant impact on margin. So we as an industry geared up to meet a demand that just isn't happening. And that's because the renewable diesel industry is just struggling. Renewable diesel is a lot harder to produce than they've let on. I listened to the earnings calls of most of the majors producers. They don't really address it, but they're universally falling behind with the timelines that they set for their consumption. The industry is geared up. Imports of used cooking oil, imports of canola oil from Canada have increased dramatically. The U.S. soy processing industry, we're all ready for the big party, and the renewable diesel industry is not there, and that's operational issues primarily that's driving that. So I'll finish this portion of my remarks with a few other thoughts. Who is here from South Dakota? And of you from South Dakota, who's near Mitchell, South Dakota? Okay. So congratulations to all of you. Your soybean basis is going to be 30 to 50 cents higher in the next 3 years. You're the recipient of the most recent investment from the refining industry into soy processing with the announcement of a plant in Mitchell, South Dakota, and a new entrant into the space, British Petroleum. So last year I talked about 3 new entrants. We had Phillips 66 with the co-op at Shell Rock, Iowa. We had ADM and Marathon jointly. And then we had a big blockbuster deal. Those were one-offs between Bunge and Chevron for revamping 2 facilities, one at Destrehan, Louisiana, and the other at Cairo, Illinois. The petroleum refining industry has entered into the soy processing space. And we just had British Petroleum 4 months ago. So this revolution is going on, and it is still incredibly dynamic. The soy processing industry is the fastest growing agricultural industry, bar none. Nothing can touch it. We're going to grow 35 to 40% over the next 2 years. There's nothing close to it. And the impact to trade is the domestication of soybeans. So the U.S., we are slowly going to withdraw from global exports on soybeans, and our domestic demand is going this way, sharply. And it has implications. If you are proximate in your land to soy processing capacity, congratulations, your basis is going to continue to trend higher. Your freight costs are going to go down. And if you're along the rivers or along major unit shipping capacity, your basis is going lower because we're not going to be servicing the global demand. It will be the Brazilians. And the Brazilians they're the global leader by far. There's no question about it. Brazil is the global leader for soybean exports. And the U.S., the good news is, the U.S., we're going to replace export demand with domestic processing demand. And that has a lot of implications for protein production and companies in the world looking at the U.S. as a major protein producer for additional livestock production. And I don't want to go on too long,
Yeah.
Kevin. I'm going to sort of cut it off right there.
No, I agree. There would be one thing I would debate is when you were talking about crude oil being aggressively higher, it should be aggressively higher. I tend to think sometimes myself and my older friends, we might be like the captain of the Titanic with the dumbfounded look a little bit, like, why wouldn't it be higher? But I argue, when I talk to the younger traders on Wall Street and younger money allocators, there's no demand story. They don't see a demand story in crude. They don't want to allocate a lot of money to crude oil. They don't see the future of crude oil. You already have OPEC cutting, trying to taper supply, and demand, you've probably peaked. And so you don't have the demand-driven bull. There's a lot of people on Wall Street think crude will be at $50 by the end of the year. So, I mean, I don't know. You have two different dichotomies. I just worry that us older folks reference what we've seen in the past a lot. And you got to remember, a lot of the younger folks are who's allocating the money and who are pushing and driving some of the markets. So I agree with Walter on the soy side. I think, California's a big proponent of the renewable. I think you see it as a story that the younger people are behind and they like. And so I do believe we may be in the midst of a demand-driven bull in soybeans. And as Andy would tell you, or myself, most demand-driven markets, bullish markets, always give you an opportunity to get in, don't they, Andy? I always give you an opportunity to get back on the train. They'll go up, and then they'll drop back and try and find balance, and then they'll take off again, and then they'll pull back. And, I could see that playing forward here to some degree. I'm interested to hear what Emily has to say. Emily, like I said, travels the world and does a great job in the soy complex and some of the other things, and speaks in his leadership around the world and in the space. So let's hear from Emily, and let's hear her thoughts.
All right. Good morning. I don't get to speak in the U.S. very often, and probably after you hear my comments, you'll understand why. I grew up on a farm in North Idaho, so very familiar with that. Started driving truck at 12, combine at 14, started my trading career with Cargill, and now most of my clients are outside the U.S. So Pakistan, Indonesia, Turkey, Malaysia, Vietnam, Philippines, and so on, Australia. So I come from this much more from a consumer perspective. Major importers, and it's really fascinating, the curiosity when you're dealing with the markets outside the U.S. because they don't have the luxury of having domestic production. They're vulnerable to freight, they're vulnerable to interest rates, they're vulnerable to the U.S. dollar, they're vulnerable to supply chains. And so if you take anything away from the comments that I make, winter is coming. I think the market has been solely focused on the supply side, that we have completely abdicated and forgotten about the demand side. And I can tell you, from the world's largest flour mills, feed mills, crushers, the world has a problem. To be very blunt, and my mom would be so proud, China is fucked. I am a China bear. I have been a China bear, and I continue to be a China bear. The China real estate bubble will be a magnitude that we do not understand, and in the US, we went through a real estate crisis, bubble, and so on. The world does not need a steady, comfortable US economy. The world does not need a steady, growing, stagnant EU 15, and I say 15, not 25 or 27. The world doesn't need that if we're going to increase demand. It needs China. The One Belt, One Road initiative. What happens when China starts calling that debt in? The World Bank, the IMF, and so on, they have no idea actually how much money China has loaned to countries like Bangladesh, Egypt, Pakistan, Southeast Asia, and so on. And so if you have China pulling back their money supply, Consumer demand is awful. Awful. So yes, they have reserves, but that's just a one-off. So that's when I say winter is coming. And I have had this conversation with my parents. Again, they farm, my brother farms, no one listens to me, so I don't expect anybody in this room to listen to me, and that is fine. But if I'm a farmer, I'm going to use the carry, I'm selling my crop, I'm going to re-own it via options, buy call options, it's a known price, it's a known risk. Volatility is exceptionally cheap. Options are exceptionally cheap versus 3 years ago. When the VIX, let's say optionality is 20%, it's not 60%. And it's volatility plus the time that dictates the cost of said option. I think the basis level in the US can get very interesting. So if I'm doing something, I'm probably, or want to participate a little bit, I'm more conservative with pricing basis. But futures, done, dusted, be done, and say thank you. There are 3 things that are driving this market right now, and that is market structure, momentum, and money flow. I do think that the managed money has plenty of room to add to their short position. The corn short is only 55% of the previous record short. Managed money, the only thing that managed money is long in the grains and oilseeds is meal. Ergo, I do think you can see front-end meal. Once they sell that, I think you will be sub 300 versus the May futures. If that is the case, you are talking about soybeans sub $10. People say, well, Brazil. You know, okay, yes. Is Brazil's crop going to be over 160? No. But does it matter? I don't think it does. And in fact, most people are like, well, what do you think? I was like, I don't care. Because I've learned a long time ago, the most valuable thing you can do, period, as a human being or owning a business is this very simple principle that we learned at Cargill, and that is if you can measure it, you can manage it. If you can't measure it, get it off your plate. Because you can't manage it, you can't control it, you can't influence it. So I would offer that. Regarding soybeans, so I look at everything in a supply cushion, and I remove China because, you know, if you look at the ending stocks, we know that they have a lot of, well, actually no one knows what China has except China, and even they don't know. So begin and end there when you've got 1.2 billion people or whatever. So when I look at the supply cushion, that is, if the world never produced another ton of grain or oil seeds, what would you have on hand? And this is why I don't give a shit about Brazil, frankly, because with the corn market, it's the smallest supply cushion, and it's 46 days. Does anyone realize that last year in 2223, the rest of the world, again, ex-China, corn production had the largest decline on record. World corn production. The market has declined $2 a bushel since then. That, to me, says more about this market structure than anything else. That you've actually lost $2 a bushel, even though you had record production loss in 2223. That's interesting to me. World corn demand, and same with meal demand, I'm very much a demand bear, and again, I don't think the market understands what's happening in these emerging economies in terms of that protein consumption and protein demand. If you look at the US, marketing year to date to this new marketing year, we just got the numbers yesterday, domestic meal demand is actually down 2%. That's not bullish. China crushing less than 2 million tons a week is not bullish. Brazil holding 50% of the rest of the world's soy stocks is not bullish. And in fact, the last time that happened was pre-COVID, if anybody remembers that. And the range in November futures was 850 to 950. So these aren't abstract, numbers. It's just if Brazil, the world's largest soy exporter, holds 50%, it's kind of the same thing as the corn market. The US holds 47 to 48% of the world's corn stocks. Or again, removing China. The last time that was, corn traded between $3 and $3.50. So I do advocate that I think what's going to happen is that globally, and again, the US is the US, and it's an island, and that's why I think basis is quite interesting. But when we're looking, and I'm dealing with hedge funds and investment banks and these importers, when we look at it, the path of least resistance continues to be lower. The risk of a supply shock in the next Q1 into Q2 is minimal. And then Brazil Safrina, that's a last half July, August 2024 impact. So that impacts 24, 25. It doesn't impact this year. So I would look for widening carries. On bear spread corn, I think you can trade the major moving averages with the wheat spread, so that's Chicago. Those should continue to widen. I am short May meal. I own put and put spreads in May meal forward. I am long KC wheat, short Chicago at -1. So that is Chicago wheat's trading at a premium to Kansas. I think that's sort of interesting on a protein wheat basis. And I would offer also anything Black Sea related as they expand. It's never bullish, right? 02, 03, that was the Black Sea invasion. That is when the Black Sea started exporting wheat. Corn has followed wheat, and now you have sunseed, rapeseed, non-GM soybeans. Obviously, in Pakistan, they've passed a law where, so we used to import about 2 million tons. My group, we handled about 1.5 million tons of that. We're now having to source all of that out of Ukraine because it's non-GM. So I do think biotech continues to be very important, and obviously the EU and the sustainability law that they've passed, the Deforestation Act, is going to add massive ripples into the supply chain. But at the end of the day, I do think you have a demand problem, and if corn cannot get out of its way, and it has 46 days, and wheat has 71, and soybeans has 110. So the world consumes 1 million tons of soybeans every day. Brazil, fine, it's 11 million tons smaller than maybe what USDA is today. Okay, that's 11 days. 11 minus 109, you're still in the upper 90s. So I think it will be interesting, but I do think 2024, we are going to see the markets swing away from this supply chain focus that's been all the rage. And we're all going to have to take a very, very hard look at demand in emerging markets, and so on, because futures and price action will be driven by the demand that is visual, and that is export. And those are the weekly export sales and the weekly export data that comes from all over the world. That is what people are looking at to gauge demand. And then crude, there's been a lot of talk about that. So I've been doing this for 27 years now, and Anne Frick, great oilseed analyst for Prubach. I was in Malaysia for the first time giving my first speech, which was, she was on the same platform, and oh, this is exciting. We're like the only two women. Obviously, not a lot has changed, has it?
No.
But thanks for having me. Anyway, so 2 points. I learned this from her. Soy oil, in and of itself, it's anticipatory in nature. So when California, so you saw the massive rally in soy oil futures, right? That was really anticipatory. That is the nature and the trend of soy oil. It is also the leading indicator of the complex. So if you haven't looked at a soy oil chart and said, oh, if that's the leading indicator, what does meal look like? What do soybeans look like? Third, soy oil always leads crude. Typically, crude will follow a soy oil cycle. And so when people are like, well, crude oil should be this because of the geopolitical threat, actually, if you look, soy oil's been telling you all along that the crude and energy markets were actually quite inflated. So I would leave that with that. Secondly, I think the most fun I'm having right now, I mean, I love my international clients, but I've started doing a lot of mentoring. So if any, and I mean, not to be sexist, but I mean, women, if you ever need a mentor or someone to talk to, do let me know, or that. And then I would also leave, stay insanely curious. Stay insanely curious, because, you know, I will talk to a wall, not shocking, but I think that is probably one of the most successful traits that I do see as a member of the board or boards globally, is just there's this insatiable curiosity that is out there. So I would leave you with that, and just wish you the best of luck, because what you guys are doing is very incredible, and certainly not something I could do. So good luck, and stay safe and stay well, and may we have more peace rather than destruction in 2024.
Yeah, I appreciate it, Emily, for sure. The kids talked Michelle and I into finally watching Game of Thrones. So we're on just started season 3, but all they keep talking about is this damn winter's coming. And that's all Emily's saying, and it sounds worrisome on the show. So I'm thinking we probably should be a little bit worried on the winter coming here. So I'm probably in agreement. Jordan, we got some questions coming in. I'll start off my one question. Probably one of my best trades of the year last year, right? I'm down in Florida speaking for Doud at a conference he had in Miami. We were in Fort Lauderdale. And Dowd's like, you need to buy you got to buy cattle. You just got to buy cattle. You got to buy it. This stuff's going up. And I don't trade a lot of cattle, a whole lot on the board. And I thought, hell, I'll take a shot. And I traded it I did well. I kept adding into it and adding in, got out at kind of the right. It ended up being one of my best trades. And I asked Doud, what do we think of cattle this year? Greg, what are we thinking?
I think you're at a new paradigm up here where you are. I spoke a month ago at the KLA meeting in Wichita, and I said something that I've been thinking about for a long time is, I bought my first 4-H steer in 1980. By the way, my dad made me go to the bank and borrow the money for that. What was the interest rate? 18% on that. For you guys under 50, the question is, how do you make money when your operating note's at 18%? The answer is you don't. That's the synopsis of the 1980s. My point is this. For all my career in life in cattle, we've had a discussion about demand, and beef demand is the problem. I no longer believe that beef demand is the problem. I believe the beef industry has a supply problem. We have had enormous incentive to expand the cow herd despite droughts and despite cost of hay and everything else. We are still shrinking our cow herd. And there is no signal in sight that we're really going to change that. And I think it's for one really simple person as a guy that still is a partner in a cow-calf operation. Nobody wants to calve heifers anymore. If I was to name the top 3 issues in U.S. agriculture today, I would name them as labor, labor, and labor. This is an enormous challenge. And it's something across all of agriculture, but I think it's most acute in the beef industry. And what you continue to see, Kevin, is that the older guys look at these prices and they're like, we're out. And so you're going to see consolidation. And so for those reasons, I don't know that we're going down very far here, because I just don't think we have any incentive to have the supply. Now, and the point was made here, and I agree with you, and this is in the speech that I give. If you look out 10 years, the supply of protein in the world comes nowhere meeting the demand. And we're not going to export soybeans. We're going to convert oil into renewable diesel. We're going to have all this meal. And my final comment, Kevin, is this. Pigs and chickens are not pigs and chickens. They are little walking piles of corn and soybean meal. And we have to think about our opportunity in the animal protein sector in the United States versus the rest of the world. We are far more competitive than anywhere else. Let's get with the program.
Yeah, perfect. Jordan, you got any questions?
Yeah, Kevin, we're going to start with retouching on the pipeline real quick, and some folks want to know why maybe the representative community, the association reps and all those types were so slow in coming to inform and educate farmers on why this was such an important issue for the future of ethanol and impacting it. And then maybe, as Tom was saying, it doesn't look good, but what are those impacts going to be then for the future of ethanol and maybe corn prices?
I think, Tom, the question is, how come we were so slow to get out and educate people on the pipelines? It seems like everybody's for the pipelines as long as they don't go in their backyard, right?
Yeah.
Yeah. And, you know, how bad will this impact? If the pipelines don't go in, are we out on aviation fuel, ethanol?
If,
Better move that mic closer. Move your mic closer. Couldn't hear you.
going forward in the renewable space, at least in bioethanol, you're going to have the have and the have-nots. And if you can't sequester CO2 to be able to take advantage of some of these programs out there, it's the have-nots. Whether that puts enough pressure on local people to be able to put those lines in, but it's definitely, they didn't do a very good job educating it. I think they thought people would come and welcome it, as which they should have, but they didn't understand. Like I said, you come out to western Kansas, hell, I got fields that have got a dozen pipelines going through them. I never know they're there. But they didn't like the idea of eminent domain, and the very people that would have benefited were the ones that fought.
Yeah, perfect.
Hey, Kevin, I'll just add, because this was surprising to me, but I attended a conference where the CEO of Darling Industries spoke. I didn't know these stats, but they absolutely hit me between the eyes. But airline usage of fuel is 8 times road usage, road fuel, 8 times.
Wow.
If you add in UPS, FedEx, et cetera, it's 10 times. And if you add in military usage, it's 12 times. So you're talking about, you know, we've had ethanol policy, we have renewable diesel, et cetera. Sustainable aviation fuel is at a level that's, for you as a market, it's at a level that's, you almost can't get your arms around it. It's so big. So if you put your perspective on the pipelines and what the implications are for the ability of the ethanol industry to produce a sustainable aviation fuel, the opportunity set is gigantic. It's absolutely gigantic, and I don't think that the promoters of the pipelines do a great job of laying out the case to people about the size of the market and the size of the potential.
That's the first time I've heard that number that you've rattled off. Yeah, I didn't.
Yeah, it's the first time I heard it. I was amazed.
Yeah. Next question.
Getting a ton of questions on cryptocurrency, so I guess just general, let's just go with general outlook in 2024.
Yeah, general outlook on cryptocurrencies. Well, you guys know my stance. I mean, I've added into Bitcoin several times on the break, so it's probably my biggest position at the current time for overall portfolio of any asset, probably. I'm bullish. I'll go on we're going to do that podcast after lunch. They'll probably ask me the same thing. And the question I had, but I'm a trader, right? So my question is, and that's why I asked Andy, I said, who the hell is going to be the natural seller right here? And so you always ask yourself, who's the buyer and who's the seller? Like in the crude oil, I said, who's the big buyer if the younger kids are allocating money or moving money? So I say, who's the big seller of Bitcoin right here? Well, I don't think anyone, because I think most people, I'm not saying anyone, but I'm saying most people on the run up where they bought it or whatever, prices went down, took a little beating, they got out and they exited. They didn't get back in. Most of the people I know didn't get back in. But right now, who's in the market and who's in Bitcoin? Some of you in this audience, I know we got some polls out there to ask, but I would say you've got institutional money in and you've got diehards in that aren't ever going to probably sell. And so who's the natural seller? I don't think you have a seller at this point, a big seller. I think everybody's buying into the news that we're going to have an ETF and easier ways to invest. Fidelity's in the running. Fidelity controls, a majority of the 401k and retirement money. I think you're going to have allocation from that coming to the sector. So, maybe we run to 100, 200K, and you have sellers at that point. you got to get the Uber drivers back talking about being long Bitcoin. And that's how I've traded it, just to let you know. I went to a gym out here. We were lifting, Jordan and I, and on the first run up, I had a bunch of guys in the gym. They didn't know who the hell I was or anything. They were telling me about Bitcoin. These are guys that own automotive repair shops and everything. They're buying it. I told Michelle, I said, we got to get the hell out of here now. I got to get to a computer now. She's like, what's wrong? And I said, I got to sell. I got to get out. I mean, it was a great sell. And then the next go around, same thing. Once everybody, I was getting in Ubers down in Miami and Florida, and they were telling me about buying Bitcoin. Again, they didn't know really who it was. And I told Michelle, I said, I got to get out of this damn thing. So I got out and bought back in on the rundown. And now we've kind of loaded back up again. We can get into more specifics later, but go ahead, David.
Thanks. It's an interesting instrument. It's a flight for security. What are people looking for? So it's something new. But I put the parallel to it in Emily's reference there to winter and where do people go. And if you look at one thing that has held its price and still gaining today, it's over $2,000 an ounce, is the price of gold. And it's telling us something's going on. But more importantly, if you look at the structure of the gold industry, you've got the gold itself, then you've got the miners, then you've got the explorers, the guys who are out exploring. If you look at the relationship between the gold price and a miner, there's some relevance. But if you look at the future of the explorer, the guy who's still trying to find it, they're selling at a hell of a discount.
Yeah.
So if you come back to, is winter coming? I believe it's coming. Is a freeze coming? Yes. The consequences of a freeze could be a total decoupling or a total collapse of our monetary system as everyone fights to lower the value of their currency to get themselves more competitive onto the marketplace. So you look at all the recipe, all the ingredients that are coming together at the moment, and the generation, my children's generation, my 30-year-olds, who haven't experienced, again, the oh shit moment in life, because they've had a pretty good run, I sense that it isn't going to come via a war. We've learned how to manage a pandemic. I think it could come through a Black Swan event in the value of currencies and a decoupling of the currencies from where they are today. And Bitcoin may play a role or may not play a role in it.
Yeah, I would agree. I think that there's an opportunity for sure. I think Andy's bullish gold and silver, correct, Andy?
Yeah, I certainly, I'm a gold bug, so, I pissed away more money in gold than I'm worth, but, yeah, I'm hope springs eternal.
Or
I
dies
hear you,
last.
But, I think your point about Bitcoin is interesting, but, you're a pen stroke away from governments banning it and doing other things like that changes the entire dynamic. And I'm not smart enough to know when that would happen. And when I sit here and look at, 5 to 8% a day swings in values at $45,000, that's awful hard for me as a trader to trade. It's a position you got to put on and live with, and you can't be trying to trade that. There's no liquidity to trade it in, right?
Yeah, there's a liquidity issue, that's for sure. We've rolled a lot of positions out of GBTC, which is the Grayscale Trust, and last week we rolled a lot more into BITO, which is based off the futures contracts. The only reason I like trading the futures contracts, because I'm just worried, like Andy says, we always call it being right the market, wrong the trade, right? I'm right the market, wrong the trade. That means you got in the wrong month, you got in the wrong contract, or you got in the wrong stock. Well, if GBTC doesn't come out and get the first ETF and Fidelity beats them to the punch, or Scaramucci or someone else beat them to the punch, it's probably going to be a problem. And you'll start to trade at GBTC at one point was trading at a 50% value deflated premium to the actual price of Bitcoin. So we were buying it, and now we're back to close to par on it. But I would say you got to be careful of what instrument you buy. That's why I like this BITO or trading the futures, because I don't have to worry about getting hacked. I don't have to worry about I don't even know all the terms that are used. I just don't know enough about it. So I trade it from a future standpoint, or try to somewhat own some cash Bitcoin, but same type of issue. So yeah, I'm with you. It's difficult to trade. It isn't.
Yep.
And we keep a core position on it all the time. Just like I told you guys, you got a core position on, you trade around that. So we've never been out of the core position. But yeah. One more? We
Yeah,
got time?
we got about 5 minutes left, probably. 2 questions I'll throw at you can touch on. Thoughts on cotton acres in Brazil, and we had a few questions on dairy outlook in 2024.
Well, Doud, you're the dairy guy, and I know, Farley, you got cotton mills and everything else going. So what do we think, Doud, on the dairy? Go ahead, Greg, on dairy. What
On
do we
dairy?
think? Where are we at?
We're really watching what's going on the processing side of the equation. We're building $4 billion in new processing in the U.S. on the dairy side of the equation. We've got a big one that starts a year from now in southwest Kansas. So, you know, to me, we're gearing up to meet and fill that processing capacity. We're easily the most efficient dairy industry in the world. We have huge opportunity outside of just the price of milk, though, in dairy. With the greenhouse gas emissions, there are now 343 methane digesters in the dairy industry in the U.S. You know, huge revenue opportunity in all of this. When you say cottage cheese, you know, dairy is a growth industry. And if it weren't for, you know, the challenges that we have on the export side and the challenges that we have in China, I think we'd be doing really well. The issue is on dairy is that we're going to fill this processing capacity. We're going to have the production, which means we're probably going to be locked into some really tight margins for some time to come. But we can manage that, and we've got a really good risk management program now that our government provides. And so, I think it's going to be, there are not going to be no, huge gains, no fat cats in the dairy side of the equation, but we're going to grow. And I think on the margin, we're going to make a little money doing it.
Yeah, perfect. David, what are you seeing on the cotton side?
The cotton side, look, without doubt, Brazil, like Australia, the farmers don't farm to a program, a government program, they farm for profit. And while ever they can make a profit, that will dictate the crop they'll grow. Cotton itself, as the consumer moves itself up the value chain, in other words, the consumer gets more disposable income, they prefer to buy a natural fibre over a synthetic fibre. As we're challenging the world now with synthetic fibres, microfibres getting into our food chain, into the fish chain, into other forces of human consumption, cotton has got more appeal to it. And the cheaper you can grow cotton, in other words, the quicker you can leverage technology into the cotton field, into either the equipment or into how you manage it spiately with your measurements, the cheaper you can grow it. So I would sense that Brazil is going to grow a lot more cotton. And whatever it can keep the real priced competitively against other currencies, literally against the US dollar, and return it, it'll play an important role. Brazil's cotton industry is principally financed by the chemical suppliers, the major chemical suppliers to it, who supply enough crop finance to those farmers to grow, and in turn their security is a lien over the crop. They don't have the pleasure and the luxury of the storage facilities that Australia and the US have got, so that cotton will definitely go to the marketplace. So in summary, I think you'll see Brazil grow a larger crop, and with the genetics they've got available to them and the technology now of farming it, they'll grow a better fibre than they've ever grown before. So they'll start shifting up into the comb field account yarns, etc., and put a lot of price pressure on the value end of the cotton curve. And the same story is happening in Australia. And both Brazil and Australia are counter-seasonal to supply, so that gives the opportunity to shorten the carry for the global spinner in particular. So if you look at it, it's a blend of currency, it's a blend of technology, and the cost to carry. It makes it understandable that you'd see the Southern Hemisphere, if Mother Nature allows it to happen, that those crops will get bigger.
Perfect. I'll end on one little positive, or maybe it's positive, I don't know. One of my other best trades last year was being long the rice market. my current biggest position in commodities is I'm long rice, thanks to my buddy over here, Andy Daniels. So we still bullish rice in this scenario?
Absolutely, yeah. I mean, it's a world unto its own, and it's nothing you can get too excited about. There's only 11,000 open interests. There's 1.1 million in corn, so put it in perspective. But it's a very small crop. It's a unique crop. We are an exporter. We're a domestic consumer first and an exporter second. We compete with Brazil and this hemisphere, and pretty much everything on the other side of the world stays on the other side of the world. Last year, Brazil was trading at $12 a hundredweight, and we were trading at 18. This year, we're trading at 18, 17.50, and they're trading at 27. So we're the supplier to the world. No one else is doing it. Last year, we sold 52 million hundredweights in the export market. We already sold that for this year, and we have 7 months to go in the year. So I think it's going to be a market that we're going to essentially run out of. It's a market that goes up and down, and it doesn't seem like at any given moment for any particular correct reason, but we have a big export market and no one else to compete with. You know, up till a month or two ago, we were the cheapest rice in the world. We were selling rice into Western Africa, which we haven't done in 20, 30 years. So I think we have a very unique situation with problems in Asia, in India, and in South America. They had a bad drought last year in their rice-growing regions, and now we're the only game in town. And we've never seen that combination of, you know, being the lone wolf. And so, you know, if we export too much right now, we're going to end up having a problem because it's impossible to ration domestic consumption because, you know, Fido needs to eat and Bubba needs to drink. So it's not going away, and I think you're going to see rice currently trading $17.50, $18, go up a lot more than here. And I don't want to throw any numbers out there to get people too excited or look at me too crazily, but I think we're going a lot higher.
Yeah, perfect. So, again, yeah, I think there's been some great conversations, great thoughts. I know everyone's going to be around for the whole conference, and like I said, ask people questions. I know everybody up here more than happy to help and share their thoughts and opinions. So, again, I appreciate it, guys. It's time for lunch. I think we're a couple minutes late, but yeah, break, head out the doors, and get lunch. We'll be back in here to start up again at 1 o'clock. Thanks.
Notorious.